Well, hey there, everyone. Happy Halloween, and welcome to Chart This with Dave Keller. I'm your host, Dave Keller, coming to you from a beautifully fall day here in Redmond, Washington. The kiddos are going to be trick-or-treating in the rain, as is normal in this region of the country. But I hope wherever you're at, if you're going out trick-or-treating, or if those days are behind you or ahead of you or happening now, I wish you a joyful Halloween. I hope it's everything you wished for, and happy almost November. Choppy finish to the month here. As we're going to see, we'll do a brief market recap. You'll see the S&P 500 basically choppy, sloppy, tested yesterday's high, tested yesterday's low. In the end, finished almost exactly at the midpoint of yesterday's trading range. So this was a very choppy session, net positive for the major indexes going into the weekend. Today, we're going to do a brief market recap. As promised, we're going to do an all-mailbag episode. So I've hand-selected some questions coming from viewers like you in the last week. Thanks so much to those of you that are watching. And as a reminder, questions are always welcome on our YouTube channel. Just use the comment section on any of our videos. Drop questions as they come up, and we will hopefully answer one of your questions in our next mailbag episode. We have a live Q&A coming up next week as we evolve our content. I'll share with you some info about that in a little while, but let's quickly check in on the market. So here after the close on Friday, October 31st, 2025, we have the S&P up 0.25% at the close, but you'll note a big sell-off in the last 30 minutes, similar to what we saw yesterday. Now, yesterday, market had actually been selling off since around 2 p.m. Eastern. Today, we actually were rallying in the 2 o'clock and the beginning of the 3 o'clock hour, 3:30 to the close, though. Sell-off going into the end of October. So first trading day in November coming up on Monday. What I was mentioning with the range, though, is if you look at the S&P 500, here's the last 5 days. Here's yesterday's trading session. There's the high around 68.80. Here's the low around 68.20. You can see we opened at yesterday's high. We traded down to yesterday's low. We traded back to yesterday's high. I mean, literally, we were just trading within yesterday's range. So the sell-off Wednesday turned into Thursday and Friday's choppiness is how I would describe what we saw today here. VIX actually pushed higher by about 0.5 point, finished the week around 17 and change. It was up around 1850 earlier in the day, around midday, but did come off a little bit here. Dollar flat, yields essentially mixed. Bond prices were slightly lower, but the yield curve was just sort of chopping around here. Gold and silver did move slightly lower. Energy did a little better today with crude oil prices up. Cryptocurrencies recovering a bit. Bitcoin got down to around 106,500. Did rally up to around 111,000 earlier today. Currently trading just around 109,400. And you can see what else is there on the sector side. Amazon having a ripper of a bullish day here after earnings, leading the way higher for the XLY, which finished up 2.6%, a big jump down to energy and communication services. 4 of the S&P sectors were down. Materials and utilities were at the bottom of the list. Breadth was a little better, but not awesome, but definitely not worse. You got 58% up and 40% down. That's one of the better breadth days we've seen in a while. Certainly the best day that we've seen this week. On the Magnificent Seven side, Amazon up 9.6% into the close. Tesla also rallying. Netflix bouncing off of a pretty weak level. But I think the real story here are names like Microsoft and Alphabet, stocks that had gapped higher that are just fading. Meta, which sold off and just accelerating lower post-earnings this week. So very much mixed results. Amazon really the only name kind of really driving higher, but all those stocks, including Amazon, that gapped higher on earnings, had good earnings, they all sold off during the day. So investors selling off on the strength, and that's why the little preview chart of the S&P 500 has 4 solid candles out of 5, because after Monday, it was intraday distribution across the board, particularly today and yesterday, with sell-offs going into the close. We're going to dig into those themes a lot more. Obviously, the Hindenburg Omen fired again this week. We did put out a video on that, and actually earlier this week on this show, I think that was on Thursday's episode, we talked a lot about the Hindenburg Omen in a little detail, and so I hope you have a chance to go back and review that if you missed Thursday's episode. But we will be digging more into these macro themes for our Market Misbehavior Premium members. As always, No better time than today to become a premium member. My goal with the premium members is to take a relatively small number of investors, really hold your hands, help expand your thinking, broaden your horizons, and improve your decision making using technical and behavioral concepts. There's a community. There's a bunch of courses you have access to. There's a commentary only for my premium members. My weekly and monthly report, which will come out next week, only for my premium members. You can find out more info at marketmisbehavior.com/premium. And don't forget to use the code YouTube when you sign up for 30% off your first 12 months on any plan. It would be awesome to have you join me there. All right. As a reminder, these questions have come from people like you watching the show in the last week, using the comments section on our YouTube channel. And please keep those great questions coming as you review my content, and I will hopefully answer one of your questions on a future episode. All right. The S&P has many divergences, RSI, percent of stocks above the 50-day, etc. However, you also cite that they are over 50, right? The RSI value and the percent of stocks above the 50-day. Good point. So what is more important, and what do you act on, the divergence or the level? Ooh, I like that question. And so just to set the table here for my answer, what are we referring to? Well, I often refer to the S&P 500. We look at this chart every day on the show. The idea with this chart, it's a daily chart of the S&P 500, just price, key levels, trends, moving averages, and then RSI at the bottom. RSI for me is the most important measure of momentum. There are a number of different ways to measure price momentum, but I found this to be particularly helpful because it helps you see where we're at, based on the momentum of the day-to-day movements in the price, the up days and the down days. And so both are valuable, right? And I would say both of them are important. Divergences don't happen all the time. Divergences are a little more rare, but I found very important. And I guess the way to think about it is there are leading indicators and there are lagging indicators. And actually, you can use RSI in kind of both ways. The leading indicator way that you use RSI, or the way you use RSI to sort of anticipate a peak, is you look for divergences. You look for when the chart is making higher highs in price terms, but what the momentum is sloping downwards. That's called a bearish momentum divergence. Doesn't guarantee a top. As a matter of fact, we can see in May and June, we had a bearish momentum divergence, but the price ended up moving higher on stronger momentum, kind of negated that divergence. We had another divergence in July and August. We eventually broke out in early September on stronger momentum. Right now, I think open question because we've not made another new all-time high this last week, but still on weaker momentum from September and earlier in October. So what did not happen back here in June or back here in August that would have confirmed some sort of top? Well, this is where RSI turns into more of a lagging indicator. If the price breaks below 50 and even worse below 40, that is for me a big time signal that we're going from a bullish phase to a bearish phase. You can see that here, December of 24, January of 25, February of 25, we keep making higher highs on weaker momentum. But the real bearish sell signal, the confirmation, is when the price breaks down, the RSI breaks below 40. So we have the leading indicator, that's the divergence. We have the RSI breaking below 50, then breaking below 40, signifying we're in a bearish phase. So, what's the relative performance, I guess, or relative importance of those two things? Divergences versus the absolute level. I would argue, I guess it depends on where we're at in the cycle. That's why I think what I do in some ways, there's a subjective lens with which I'm analyzing these charts. It's not just looking at the value and saying the RSI is below 40, must sell. It's not a robot kind of thing, which is why it's hard to automate some of these things. When I see a signal, I'm immediately thinking of previous experiences where previous parts in the cycle, previous bull runs, and thinking about how those have ended. And so there's a bit of a subjective nature to it. And so I would say both of them are important, but certain parts are more or less important depending on where we're at in the cycle. That's a non-answer, but that's the best I can give you. All important. And that's why something like RSI, you can oversimplify and just say, what's the value? And that gives you some piece of information, but really looking at the indicator over time and using it to the point that it's almost second nature when you see a setup. That's where I think comes with experience and comes with practice. And I hope My content here on the show helps get you closer to a point where you feel comfortable making your assessments there. Next question. You've been doing this professionally for a while, Dave. Do you have a sixth sense about the market? How have you kept track of your intuitions? What is your track record? I love the honesty and the humility embedded in your question. It's so funny, as with most things in life, and I'm coaching my daughter. My daughter's a senior in high school. She's a musician. She wants to study music in college. My wife and I both started in music. We both left to do other things. I eventually came back to music. Carrie did not. We both do it as one of our favorite hobbies that makes life so worthwhile and meaningful and fulfilling here as we've progressed through our lives, and will continue to be as long as we have breath. But I'm trying to coach my daughter on getting through the challenges, the negativity that comes from trying to be a professional musician. And what happens is, when you study music, for those of you that have not, you become a total perfectionist, right? You nitpick every little thing. If something doesn't sound exactly right, you pick up on it. Now, you perform in front of a group of knowledgeable listeners, and they won't pick up on a lot of those little problems. You and your brain know what you want it to sound like, and it just doesn't sound exactly how the sound is not coming out how your brain is telling you it should. So what happens is, as a musician, one of the more negative voices you're ever going to hear, it's not someone telling you you're not good enough. It's the voice in your head that tells you you're not good enough, you're screwing up, that's not as good as it could be. So part of being successful is understanding that and recognizing the negative thoughts that will come up if you don't sort of proactively work to avoid that, and think about gratitude, and think about reflecting on what's going well, and all of those sorts of mental tricks. And I would say, as investors, and certainly for me, grading my own performance, I'm a horrible grader of my own effectiveness, right? I mean, I always sort of, and it's so funny. I mean, some people have sort of a what's called a hindsight bias. So whereas time goes on, you sort of think that your calls were better than they actually were if you look at the numbers. But having said all that, I mean, do I have a sixth sense? Yeah. So the way I would answer your question is say this. I think a lot of times people confuse that kind of sixth sense. What do you think is going to happen? Like, if someone tells me, what do you think is going to happen through the end of Q1 of next year? I can give you a bunch of, I would say, educated guesses, thoroughly researched, and I think based on market history and where we're at. I can tell you what I think is most likely going to happen. I can tell you what's going to happen in terms of seasonality and policy decisions. Now, again, is there any guarantee that that's going to be right? I mean, no. And I would say my job, or at least my investment performance, should not be based on my ability to predict the market 6 months from now. As a trend follower, it's less about prediction and more about process. It's process over prediction. That's the title of an upcoming book I will write, fingers crossed, someday. Process over prediction. It's about process. It's about focusing your time not on predicting what's going to happen tomorrow, but on thoroughly assessing what's happening today by identifying trends and following those trends as long as possible. Having a process for identifying when things you own start to look bad, when things you don't own start to look good. And it's less about predicting what's going to happen to the S&P by next March, and more about the process of how you spend the time between now and the end of next March to navigate the markets. I don't think people get into trouble because their crystal ball is not as good as someone else's. I think you get into trouble because you miss or ignore clear signs that something's changing. So, I don't have a great, I don't know how I would quantify a track record of the comments that I do, but I would tell you one of the ways that I evaluate this, and I guess the best way that I evaluate the sixth sense intuitions and track records, is at the end of every year, I have 10 questions that I ask myself, some about performance, some about my analytical process, some about my routines and decision-making, also about mindset. At the end of the year, I will do a presentation where I will share those 10 items with you and sort of talk through, my own answers to those. I've done that every year now for a number of years. It's an awesome exercise, a great cleanse. And I will absolutely look back at this year, how I navigated the major turns. What was I thinking in January and February? Was I getting ahead of that peak? Was I recognizing signs? And how long did it take me to really turn negative after the market sold off into late February? I already know I'm going to grade myself very poorly on April, May, June, because I think it took me way too long to recognize a V bottom and have the confidence to, be more bullish when it felt to me like we were probably going to go and retest the lows, if not a lot worse. But that's something I do at the end of every year. Right now, I'm focused on what's happening over the next week and over the next month, and making sure I'm positioned based on what I think is going to happen. But that's what I would do. For me, it is critical to look back and analyze performance in terms of the comments that I'm sharing. So I review videos, I review articles I've written, and just see with the stuff that I put out there, what ended up being really helpful and what was just a total miss, and why. And by doing that consistently, hopefully I do better. Having said that, right, like your intuition, I mean, that's hard to quantify. And I think for what I found working with institutional investors, those are the things that would be like the water cooler conversation. There would be a difference between what we would talk about, maybe something that could happen versus how we were actually positioned, which was based on trends and momentum. Next question. And let me tell you what, this question wins the prize for best question I received in the last week in terms of phrasing and general vibe of the question. Dave, I know you're not in the business of catching falling knives, but I'm sure you can appreciate a good burrito. Where is Chipotle if I'm going to find a bottom? Kudos, my friend, for boldly and courageously asking that question about CMG, Chipotle Mexican Grill. So falling knives, not my thing. I'm not a big fan of buying the new lows list. I don't often look at the new 52-week lows as a place to generate ideas. I was taught prices go down for a reason. And if stocks get down that low, I probably want to avoid them because there's a reason why it's in a period of distribution. I look for a stock to rotate from a period of distribution to a period of consolidation, and ideally a period of accumulation. What you're seeing with the chart of Chipotle is a confirmed distribution pattern. Distribution means lower highs, lower lows, moving averages sloping downwards, often oversold. RSI rarely gets above 60, checks all the boxes here. You could argue this is a bear flag pattern. A bear flag pattern is where you have a downtrend, then you have a short-term upswing, higher highs, higher lows. You break down through the lower boundary, and that often indicates, signals the next big leg lower. And this week with an earnings miss, it's got beaten down pretty good. Now trading below $32 a share for the first time in quite some time. So, where is it going to find a bottom? I don't know. I mean, and I would say at this point, this is the type of thing I'm not into calling a bottom. I think in a confirmed downtrend, I look for signs of accumulation. So what would I look for? So first off, after you've had a huge sell-off like that, I think it's helpful to bring in more data, right? When you're at a new low and you look to the left and there's no other activity around there, look at a longer term chart, look at a weekly chart. I think the weekly chart's helpful for two things. Number one, because you can see we're actually getting back to the 2022 low and the late 2022 lows, right around sort of 24 to 28 or so is where you had these major lows in 2022. We're kind of getting back into that range. So from a longer term perspective, are we getting into some of those longer term support levels? Potentially. The other thing is, especially when something's been in an established downtrend, the weekly MACD or the weekly PPO is often my friend. I'm kind of happy patiently waiting for a bullish reversal from the weekly MACD. And while I can't guarantee that would be enough to get interested, if you look to the left on this chart, those buy signals on the weekly MACD have often been pretty good points. There's no guarantee because we actually had a bullish upturn here in early May. It went higher for about 6 more weeks before it ended up rotating lower and breaking below moving average support. But until I see a weekly MACD, or in this case, a weekly PPO buy signal, I'm holding off and I'm waiting. So that's what I would be looking for on CMG. It's less about a price level. For me, it's about, I now know the trend is down. I'm going to wait for something to tell me the trend is no longer down. On the daily chart, a higher low is often a great sign. A bullish divergence, that would be another maybe leading indicator. I'm not seeing either of those right now. Hey, as you've probably noticed, we've been moving things around with our show. We're actually transitioning our show to be recorded. I'm finding I'm able to keep the conversation a little more concise and focus on some of the charts that I'd like to by doing the daily show that way. But I really love the live interaction with you guys, and I want to make sure that we have some good opportunities for that. So I'm going to do a webcast next week. This is next Thursday, November 6th, 1 p.m. Eastern, 10 a.m. Pacific. We're calling it Ticker Tantrum. We'll be hosting a live Q&A. You will choose the tickers. You can ask the questions. We'll do it all live. I'll answer as many as I can within the hour that we have allocated. You can sign up and confirm the details at marketmisbehavior.com/ticker, TICKER. Again, that's next Thursday, November 6th, 1 p.m. Eastern. If you watch the show and if you like what we do, I hope you'll join for that live Q&A. Should be a lot of fun, and we'll have a couple of charts queued up just to get things started. And then it'll be driven by the questions that you ask. We can go anywhere you like. Looking forward to it. All right, next question. Now that the Hindenburg Omen fired, what do you think happens to gold and silver? Some may think if the market goes down, gold and silver may go up, but gold and silver have already gone up. Really good question. As a reminder, Thursday's episode of this week, we dug into the Hindenburg Omen in a lot more detail, talked about some of the different settings that different strategists use and why the version I use and what it means that we had that second, I would argue, confirmation signal this last week. And it's a pretty bearish omen when you look back in market history. It's not perfect. Nothing is, but it's pretty effective in my experience. So what do I think happens to gold and silver? So what you have to remember is the Hindenburg Omen really isn't tied to gold and silver, right? The Hindenburg Omen is based on this chart. It's based on the S&P 500. It's really based on the New York Composite Index, which is $NYA. This is the NYSE Composite Index. That's what drives the Hindenburg Omen, and basically looking for some consistent signals that often happen at major market tops. So what are the implications? So if the Hindenburg Omen is right, that means in the very near future here, and sometimes it's been as early as the next week, sometimes it's been 3 months early. I mean, it really is not as good of a timing tool as I think we would probably like. But for me, it tells me to look for signs of a breakdown because we are, nearing a major top, most likely, given what the Hindenburg Omen suggests. What does that mean for, for gold and silver? So, again, generally speaking, at this point in the cycle, gold has already rallied quite a bit, as you pointed out, right? Gold got above $4,100 an ounce and even further. The GLD closed above $400 a share for the first time in history, but it's pulled back now. The GLD got down to around 360, so it's about a 10% correction off of the mid-October high to where we are here going into the weekend. So it's already pulled back quite a bit. So I would say if stocks would sell off, given the fact that gold had the run and pulled back, I would not be surprised to see gold push higher fairly significantly. I think that is reliant on a couple different things. I mean, I think what would be a tailwind for gold would be the fact that it's a safe haven, and it's seen as a safe haven. It's seen as a store of value. So people are nervous about equities and start unwinding equity positions. Gold is a logical place to go because it tends to have a low correlation to stocks and has tended to hold up pretty well when stocks have been struggling quite a bit. Gold tends to do well during periods of persistent inflation, which is something that, as much as some people would probably try to argue that's not the case, I would argue it very much is. Inflation's still there, and it's still a thing. I would say one other thing would be the U.S. dollar, though. One of the reasons why gold has done so well is because the dollar has been so weak. So I would say if there's a big spike in the dollar, the uptrend in gold may be a little more tempered than otherwise. But overall, I would say at this point, given what's happening, and if the market would really sell off in terms of equities, I would expect gold and silver to do quite well. I still have a decent position in gold through a couple ETFs based on that expectation, just as a way to hedge what could happen with equities. Next question. If a position is extended and I shouldn't add to it, isn't that essentially the same thing as saying that I should back out of it and wait for it to pull back to support? I get what you're asking. I think I get what you're asking. What I think you're asking is, some things. Yeah. So right and I think this gets to some of the language that I use. I will often talk about something being extended, right? Alphabet as a chart is pretty extended, meaning it's moved up a ton. A lot of semiconductor stocks extended. And what that means, overextended, means it's just gone up, in a big way in a short period of time. And so that just usually is unsustainable, right? So when it's overextended, what I'll often say is, great chart. Today, maybe not the day to take a new position because we're probably going to get some sort of pullback. Because what you have to remember, and I guess what I'm getting at with these sort of things is when you have something that's in a big consistent uptrend, think of it like a channel, right? Even though the larger trend is up, we're going to have these little short-term upswings and also short-term pullbacks. So the idea is, instead of buying at all the peaks, why don't we buy more toward the valleys? And that's why we often look for charts in good uptrends, but pulling back to a 21-day exponential moving average. That's why Alphabet looked really good here in late September, kind of early October. Strong uptrend, new highs, higher lows, and that higher lows pulling back to the 21-day EMA. That's often a really good time to layer into a long-term trend. What we are saying is, if I'm saying it's overextended here, you probably don't want to take a position. Why not sell here and then buy in at a weaker point, right? And so instead of just buying on pullbacks, why not sell on upswings and buy on pullbacks? This gets more to what you're trying to do with your portfolio, and this is why nothing that I share on this show or any of my content constitutes a recommendation. I'm never saying, hey, viewer, you should buy or sell this stock at this level. That is not my game. My game is to teach you the technical and behavioral tools that will empower you to make decisions in your own portfolio, right? And develop rules and approaches that help you get better results and more consistent results over time. So some of you may be more swing traders where your goal is to buy and sell short-term swings. That's what we would call kind of trading around a position, right? Some are more position traders where you're not looking to have a lot of entry and exit points. You just want to be able to accumulate and buy on short-term weakness. And so that's why I don't say you should buy here, you should sell here, because I don't really know you and what you're trying to do in your portfolio. And that's, I think, an important sort of wall that I won't go through, because I don't think I'm equipped to help you understand for your particular approach what makes sense. What I would encourage you to do is think about what makes sense for you and the portfolio that you're working with. And if you're more of a swing trader, then that would inform how you use some of those indicators to identify short-term swings and maybe sell into strength and buy into weakness. But if you're more of a long-term investor, more of a position trader, you're probably not looking to sell into strength too much. You'd much rather just accumulate and buy into weakness. But having an awareness of yourself, looking in the mirror and having an honest conversation, I think is what's most important. All right, final question. Then we'll call it a Halloween night and a joyful weekend. What's the best example of a bull flag pattern? ZM, NU, or Merck? I mean, three pretty random stocks that you hand selected there. Zoom's one of those. Zoom, Peloton. These are like the COVID names, right? I mean, the names that just all of a sudden went crazy during COVID when we're all at home and riding bikes in our own house and doing Zoom calls a lot more than we ever had before. But it's actually starting to improve here, making a higher low at the 200-day moving average, testing a new 3-month high here going to the weekend. Not bad. So I think you're talking about probably this point right here. All right, that's not bad. We'll come back to that one. What was the other ones? NU is new holdings. This is in the financial sector. You're talking about this one right here, this bull flag. Okay. Both of those are decent, I would say. And then Merck is the third one. So I'll tell you right off, I mean, maybe you're talking about this back here or this. Yeah. I mean, they're all not bad, right? I mean, if you think about what makes, I don't know if I would really be able to differentiate. Those are all decent examples, right? I would say, what makes a perfect example? So I would say, Merck is not perfect yet because it's not fully formed, right? You need to have a parallel channel of lower highs and lower lows. So we need to come down a little bit here to create a parallel channel. And remember, it's not a confirmed bull flag until and unless we break out above that upper boundary. So I would say Merck probably not the winner. With NU, not bad. This is a pretty decent parallel channel. And again, the trigger is here and we break above the upper trend line. So NU is probably the winner, I would say. What about Zoom? Zoom's not bad. So Zoom's not as good because the uptrend isn't as established going into that peak. What you really want is a long uptrend and then the short-term pullback where the time frame in the flag is a much shorter time frame than a big up move. This is not quite enough of an up move to really think of that as a bull flag, I would say. So yeah, I would say the big winner of those three, NU. Better winner though for me would be Bank of America back here. And I just wrote about this. I think this for CNBC I wrote about this week. Look at that one, right? So big run higher, parallel channel, lower highs, lower lows. Again, that's the trigger. So the bull flag pattern, it's important to wait for that end, because if we never break out, then that's just a new downtrend. And eventually it doesn't look like a flag anymore at all. Make sure that you wait for that trigger, wait for that breakout. That's what validates a new uptrend and a positive resolution to a bull flag pattern. Folks, that'll do it for the show, and that'll do it for the week here on Chart This with Dave Keller. Thank you so much for joining me here all week and for joining me on the show. Happy Halloween to all of you. Stay safe. Have a joyful Halloween and a great weekend. As a reminder, our Ticker Tantrum live Q&A is coming up next Thursday, November 6th at 1 p.m. Eastern. You can find more information at marketmisbehavior.com/ticker, and that's the same website you will use to go access the event next Thursday, November 6th. So I hope you'll join me then. In the meantime, have a great weekend. And remember, it's always a good time to own good charts. Take care, folks.